Bitcoin just lost 67,000 and the Fed hasn't even spoken yet. The rate cut dream is dead, but a truce in Iran could save us all by Monday, Thursday, June 18, 2026. Like and subscribe for daily market updates. Today's agenda: the Fed shock, market snapshot, macro and inflation, Iran deal watch, crypto pulse, earnings and deals. Up next, market snapshot. New chairman Kevin Warsh walked into the room and immediately changed the rules. He refused to submit his own dot plot projection, slashed the policy statement down to about 130 words, and ripped out every hint of easing bias from the text. The median dot for year-end rates jumped up 2 percentage points overnight because 9 officials now see at least one hike before 2026 ends. That is a massive shift in central bank policy direction compared to March, when everyone expected cuts by summer. Warsh also announced 5 task forces designed to overhaul how they communicate and manage the balance sheet, signaling fewer press conferences going forward. Here is the big picture on why these numbers matter for your portfolio today. Stocks closed red across the board after Warsh's debut meeting. The Dow fell almost 1% to 51,492 points, while the S&P 500 dropped over a point and a quarter down to roughly 7,420. Small caps slid with them because they are most sensitive to borrowing costs rising again. Crude oil is hovering near $76 after tumbling nearly 40% from its wartime peak as markets cashed in on the ceasefire deal signing tomorrow. Gold pulled back more than 2% to around $4,250 off of that $4,300 plus high it touched earlier this week because a stronger dollar and higher real yields punish precious metals directly. That brings us to Iran deal watch. Headline inflation data is currently tracking at 4.2% year over year, while core inflation hovers near 3%. However, PCE data indicates prices are actually accelerating faster than headline figures suggest due to sticky service costs and housing rents that lag behind goods deflation. This divergence creates a complex puzzle for the Federal Reserve, which must balance cooling demand without triggering a recession. The May jobs report added 172,000 new positions, with unemployment steady at just under 4.3%, signaling the labor market remains tight enough to keep wage growth elevated above the Fed's 2% target. When wages rise faster than productivity, unit labor costs climb, creating an upward feedback loop that forces businesses to raise prices again, effectively reigniting inflation even as interest rates hit multi-decade highs. This dynamic recalls the early 1980s, when Paul Volcker famously raised rates precipitously to break wage price spirals. Today's environment differs because supply chains have normalized and global competition is fierce, yet the psychological anchor of high wages persists. Retail sales surged almost a full percent last month against expectations of 0.5%, because consumers simply refuse to roll over despite higher interest rates everywhere else in the world, driven by pent-up savings from pandemic-era fiscal stimulus that has not fully dissipated. This resilience masks underlying fragility. If real disposable income turns negative as mortgage payments and credit card debt service costs continue their ascent, consumer spending could snap back with violent speed. For investors, this implies a prolonged period of higher for longer rates, where the central bank will likely tolerate elevated inflation to ensure they do not miss the turning point in wage growth too early. Consequently, portfolios must be structured for unpredictable price swings rather than assuming an immediate landing into easy money conditions, as any premature rate cut could reignite expectations that force asset prices lower before stabilizing again. Which leads to crypto pulse. The dominant narrative dominating global financial flows right now revolves entirely to Iran, where the clock on a potential diplomatic breakthrough is ticking loudly and visibly. A critical memorandum of understanding is poised for signature tomorrow at an exclusive resort in Switzerland, a venue chosen deliberately to signal high-stakes diplomacy away from the noise of conflict zones. This agreement would formally extend a 60-day ceasefire across the region, while simultaneously mandating the complete reopening of the Strait of Hormuz. For decades, this narrow waterway has served as the world's most volatile choke point. Its closure once triggered supply shocks that sent energy prices soaring globally. By guaranteeing full access for international shipping traffic again, the deal effectively removes a massive low-probability but high-impact risk from global logistics chains. Markets have already reacted aggressively to these developments by cashing in their relief checks ahead of the official announcement. crude oil futures are currently trading down nearly 40% from their wartime peaks as traders rapidly recalibrate their models under the assumption that supply disruptions will end soon if compliance holds true historically. This price correction mirrors previous post-conflict rallies, where risk premiums evaporated almost overnight once political uncertainty diminished, allowing capital to rotate back into energy-intensive sectors and emerging markets dependent on stable fuel costs. The second-order effect here is profound. Lower oil prices reduce inflationary pressure worldwide, potentially giving central banks more room to manage growth without fear of overheating the economy. For investors, this shift implies an immediate re-rating for airlines, shipping firms, and manufacturers facing volatile input costs. However, prudence dictates that, while the headline numbers look attractive, participants must remain vigilant regarding enforcement mechanisms. History shows that diplomatic agreements in high-tension zones often face implementation delays or partial breaches. Consequently, smart money is likely to position defensively until independent verification confirms actual vessel movements through the strait before fully committing long-term capital based on these optimistic price forecasts. Here is what else moved in earnings and corporate news before the bell rang today. Bitcoin hovered just below the $66,000 mark, having briefly spiked to a high of $67,000 fueled by fleeting optimism surrounding potential diplomatic breakthroughs in Iran. That rally evaporated almost instantly when Janet Yellen's comments effectively severed the market's hope for an imminent Federal Reserve rate cut, sending prices tumbling with mechanical precision. This unpredictable price swings underscores a fundamental shift. Bitcoin no longer functions primarily as digital gold or a neutral store of value. Instead, it behaves like high-beta technology stock, its price action dictated overwhelmingly by big-picture economic available cash in the market rather than underlying blockchain utility. When interest rates stay higher for longer, capital flees risk assets regardless of technological merit. Ethereum followed suit with even more sluggishness, trading near $1,650 as investors rotated out of the sector entirely. The damage is visible in the spot crypto ETFs, which have hemorrhaged over $4 billion across 3 consecutive weeks. This sustained outflow mirrors the 2018 winter following the Mt. Gox scandal and the subsequent regulatory crackdowns, where fear overwhelmed underlying health for years. Today's mechanism differs slightly. It isn't a ban on trading, but a macro-driven available cash in the market squeeze that forces institutional reducing risk before earnings season even begins. For investors holding these assets, the implication is clear. Position sizing must now account for interest rate sensitivity rather than just adoption narratives. The current environment suggests that until inflation data consistently cools and policy pivots definitively toward easing, crypto remains a leveraged bet on Wall Street investor mood, not an independent asset class insulated from economic cycles. Here is the final read on what matters most for your money over this long weekend ahead. Accenture's fiscal third-quarter earnings report arrives with Wall Street anticipating roughly $3.7 per share against approximately $18.8 billion in total revenue, a critical juncture for the world's largest professional services firm by market cap. This quarter carries significant weight because shares have already retreated around 46% from their 52-week high, reflecting growing investor skepticism regarding the sustainability of its growth trajectory. The core question now transcends simple quarterly company outlook. It probes whether Accenture can successfully convert massive AI consulting bookings into tangible, recurring revenue, or if artificial intelligence quietly dismantles the very consulting model that built this empire over decades. Historically, similar tech giants have faced existential threats when their primary service offerings became commoditized by automation, forcing a painful rate change from billable hours to outcome-based value creation. If Accenture fails to demonstrate how its AI tools enhance rather than replace human consultants, second-order effects could include margin compression as clients demand lower fees for automated deliverables, and increased churn among mid-tier partners unable to compete with pure-play software vendors. For investors holding positions in this volatile stock, the implication is clear. Valuation price-to-earnings ratios must contract until management proves that technology acts as a force multiplier rather than an internal disruptor. The market will scrutinize every line item to determine if the current discount represents a temporary overreaction or a structural re-rating of the entire sector's promise. Without concrete evidence that AI drives new revenue streams faster than it erodes traditional consulting margins, capital allocation decisions may shift away from high-beta tech services toward more defensive sectors, where human expertise remains irreplaceable despite rapid technological advancement. Fed rate cut odds have collapsed to 60% following Fed Governor Michael Warsh's hawkish comments, which significantly raised year-end inflation projections and pushed yields higher. This shift squeezes growth stocks as investors adopt a risk-averse stance ahead of the Iran deal signing this weekend, though markets will remain closed until Monday for full reaction. Meanwhile, oil prices must stay below $76. Breaking above that level could signal a fragile ceasefire, triggering stock declines and gold spikes, before any portfolio relief arrives next week amidst these rapidly evolving global economic conditions. Thanks for watching Market Pulse Daily.